For small businesses, cash flow management isn't just important, it's essential for survival. Cash flow represents the amount of money moving in and out of a business at any given time. Unlike large corporations with vast financial cushions, small businesses often operate with narrow margins and limited access to extra capital. Mismanaging cash flow can quickly lead to serious financial trouble, even for otherwise profitable companies. Without steady cash flow, it becomes difficult to pay employees, cover operational expenses, invest in growth, and weather unexpected challenges. In this video, we will explore the top 10 reasons why mastering cash flow management is absolutely critical for small business success. 1. Cash flow determines day-to-day operations. Daily operations rely heavily on having accessible cash to pay rent, purchase inventory, cover utilities, and handle payroll. Even if a business is technically profitable on paper, a lack of liquid cash can halt operations entirely. Employees expect their wages on time, suppliers require prompt payment, and everyday bills keep coming. Without efficient cash flow management ensuring that incoming funds cover outgoing expenses, the business can stall, frustrating employees, suppliers, and customers alike. Maintaining a steady cash flow ensures that the wheels of the business keep turning smoothly every day. 2. It helps prevent debt overload. Poor cash flow management often forces small businesses to rely on high-interest loans or credit cards just to survive, leading to mounting debt over time. When cash reserves run low, owners may feel pressured to borrow more frequently, racking up interest payments that further strain finances. Effective cash flow planning allows businesses to predict periods of low income and prepare accordingly, reducing the need for emergency loans. Avoiding unnecessary debt accumulation preserves the business's creditworthiness and frees up resources for growth initiatives instead of debt service. 3. It improves decision-making. Good cash flow visibility allows business owners to make smarter, more strategic decisions about expenditures, investments, and scaling. When you know exactly how much cash is available and what commitments are on the horizon, you can prioritize spending, delay unnecessary purchases, and invest wisely in growth opportunities. Conversely, poor cash flow management can lead to impulsive or poorly timed decisions that can jeopardize the company's future. A strong understanding of cash inflows and outflows empowers owners to think proactively rather than reactively when opportunities or challenges arise. 4. Cash flow management builds stronger relationships with suppliers. Vendors and suppliers prefer working with businesses that pay on time. By managing cash flow effectively, small businesses can consistently meet payment terms, earning a reputation as reliable partners. This can open doors to more favorable terms, such as bulk discounts, extended credit lines, or priority service. On the other hand, missed payments or frequent late payments can damage supplier relationships, resulting in tighter payment terms, cash-on-delivery demands, or even severed partnerships. Healthy cash flow ensures that supplier relationships remain strong, stable, and mutually beneficial. 5. It enhances financial resilience. Unexpected expenses are an inevitable part of running a business, from equipment breakdowns to sudden market shifts or natural disasters. Effective cash flow management ensures there's a financial cushion to absorb these shocks without resorting to desperate measures. Businesses that monitor and project their cash flow accurately are better prepared to weather economic downturns, unforeseen emergencies, or seasonal revenue dips. Resilient cash flow management reduces vulnerability to external pressures and protects the company's long-term viability, no matter what challenges arise. 6. It supports payroll stability and employee retention. Employees are the backbone of any small business, and ensuring they are paid consistently and on time is non-negotiable. If cash flow is poorly managed, payroll disruptions can occur, leading to employee dissatisfaction, declining morale, and ultimately, higher turnover rates. Reliable cash flow management supports consistent payroll processing, boosts employee trust, and fosters a stable workplace environment. Happy, financially secure employees are more productive, loyal, and engaged, helping to drive the business forward through both prosperous and challenging times. 7. It improves creditworthiness and financing options. Lenders and investors closely examine a business's cash flow statements when evaluating creditworthiness. Strong, consistent cash flow is a green flag that signals financial stability, increasing the likelihood of loan approvals or investor interest. In contrast, erratic or negative cash flow raises red flags and can result in higher borrowing costs, stricter loan terms, or outright rejection. Businesses that prioritize cash flow management present a stronger case when seeking external funding, giving them more options and negotiating power when financing is needed. 8. It enables better growth planning. Growing a business requires careful investment, whether it's hiring new employees, expanding into new markets, or purchasing new equipment. Cash flow management allows business owners to determine when and how aggressively they can grow without overextending themselves. Clear visibility into cash flow patterns provides insights into whether the business can sustain new expenses or whether it needs to build up reserves first. Planning growth based on sound cash flow projections reduces the risk of expanding too quickly and ensures that growth efforts are sustainable over the long term. 9. It helps identify financial problems early. One of the greatest advantages of diligent cash flow management is the early detection of financial problems. By regularly monitoring cash flow reports, business owners can spot troubling trends, like declining revenues, rising expenses, or cash shortfalls, before they escalate into full-blown crises. Early intervention allows for corrective measures, such as adjusting pricing strategies, renegotiating supplier contracts, or cutting unnecessary expenses. Without vigilant cash flow monitoring, businesses risk being blindsided by financial problems that could have been mitigated with timely action. 10. It reduces stress and builds confidence. Running a small business is stressful enough without constantly worrying about whether you'll have enough cash to cover next month's bills. Effective cash flow management provides peace of mind by removing much of the uncertainty surrounding business finances. Owners who maintain a strong grip on their cash flow sleep better at night and make decisions with greater confidence. This reduced stress leads to clearer thinking, better leadership, and a stronger ability to focus on growing the business rather than putting out financial fires. Cash flow is the lifeblood of any small business, and managing it wisely is critical for sustainability, growth, and success. Without proper cash flow management, even profitable businesses can find themselves struggling to survive. It impacts everything from daily operations and employee satisfaction to supplier relationships and financial resilience. By understanding and acting on the importance of cash flow management, small business owners can avoid common pitfalls, make smarter financial decisions, and build a business capable of thriving even in uncertain times. Mastering cash flow isn't just about balancing books. It's about securing your business's future and unlocking its full potential.